Are you trying to find the best SMSF loan rate before committing to a property investment? In this video, we compare current rates from verified lenders to help you secure the best deal for your retirement nest egg. Let's dive in.
All right, welcome. If you're building your retirement wealth with a self-managed super fund and property, you already know that every single decision really counts. Today, we're going to dive deep into one of the biggest ones, the loan. We're going to break down how to get through this kind of complex world to find the absolute best deal.
Okay, let's just jump right into the big question. You've probably seen the headlines. Macquarie is out there with a 5.19% fixed rate for SMSF loans. And you know, on the surface, that looks pretty tempting. But is it really the best deal for your retirement? That's the question we're going to pull apart in this explainer.
First up, just a super quick refresher. An SMSF loan is officially called a Limited Recourse Borrowing Arrangement, or LRBA. Think of it as a very specialized tool that lets your super fund borrow cash for an investment property. And the great part is it has built-in protections for all your other retirement assets. It's a powerful strategy for sure, but the loan terms, well, they're absolutely critical. So let's get that 5.19% rate and put it right under the microscope. An attractive headline rate is one thing, but as we're about to see, it is almost never the full story when you're talking about building wealth for the long haul.
So why are we obsessing over this? Because honestly, the stakes are incredibly high. A difference that looks so small, just 0.5%, can easily become tens of thousands of dollars over the life of a loan. And that's money that should be compounding inside your super fund, but instead, it's just going straight to the bank.
And that brings us to the first really big decision you have to make, the classic debate of fixed versus variable. This choice is really a fundamental trade-off. Are you looking for certainty in your repayments, or do you need flexibility for what might happen down the road?
Look, a fixed rate like that 5.19% offer, it gives you undeniable peace of mind, right? Your repayments are locked in, you're protected from rate hikes, and that makes all your compliance and cash flow planning way easier. But, and this is a big but, here's the catch. You often give up flexibility. Making extra repayments might be off the table, and if you need to break that loan early, the fees can be huge. Plus, what happens when that fixed term is up? You could find yourself suddenly rolling over to a much higher variable rate if you're not paying attention.
So all of this really goes to show it is not just about the rate. A truly smart SMSF loan decision means you have to look at the entire picture. The interest rate is just one little piece of a much bigger puzzle. So what else should be on your radar? Well, first, how much can you actually borrow? Believe it or not, that can change a lot from lender to lender. And what about all the hidden costs in the fee structures? You've got to think about establishment fees, ongoing fees, and those potential break costs. Also, does the lender actually get SMSF compliance? And finally, what features are they offering? Things like offset accounts can make a massive difference to your fund's cash flow. And just to give you a real idea of how much this all varies, take a look at this. The spread, the gap between the most competitive rates and the more expensive ones, can be as wide as 1.85%. Now, over decades, that difference is a huge amount of potential growth for your retirement that's just left on the table. This brings us to a really important shift that's happening in the market. You know, while the major banks are kind of the default choice for a lot of people, a new breed of specialized non-bank lenders has popped up, and honestly, they are changing the game for SMSF trustees. Let's just compare them side by side. For major banks, SMSF loans are just one product in a giant catalog. But for these specialized lenders, their entire business is built around SMSFs. And that focus, it often leads to more competitive rates, more flexibility if you have a unique property or fund structure, and a much faster, more streamlined approval process, just because they live and breathe this stuff. Okay, let's make this real. All these factors sound good in theory, but what does it actually mean for your money? Let's run the numbers with a quick case study. All right, so here we've got a $500,000 loan over 15 years. With a major bank's 5.19% rate, you'd end up paying around $224,000 in interest. But with a competitive non-bank rate of 4.89%, that's just 0.3% lower, the total interest paid drops to about $209,000. I mean, you can just see the difference right there. It's pretty stark.
So what does that boil down to in simple terms? That's an immediate, upfront saving of $15,000. That is cash that stays directly in your super fund, working for your retirement, not for the bank's profit margin. But wait, it actually gets even better. That $15,000 doesn't just sit there doing nothing. Thanks to the magic of compounding, where your returns start earning their own returns, that initial saving could easily grow to be worth over $25,000 by the time you actually retire. Now, that is the true power of making a smarter loan choice. So, how do you find your best deal? It comes down to 3 steps. First, make sure your loan choice actually fits your strategy. Are you a buy and hold investor or a more active manager? Second, you have to look beyond that shiny headline rate to compare the true costs, the fees, and the features. And third, make sure you explore the entire market. And that definitely includes those specialized lenders who might just be a much better fit. Let's end on this one powerful thought. The decision you make on your SMSF loan, it's not just some short-term financial choice. As this quote says perfectly, the rate and the terms you lock in today are going to be shaping your final retirement nest egg for decades. So is 5.19% the best deal? Really, the question you should be asking is it the best deal for you?